What is going on, guys? Money Mander back again here for Kane Capital. Going to be starting a new series here today called Macro Matters. Macro Matters with Money Mander, getting all the M's in. Today, I'm going to be covering for episode 1, the Phillips Curve, exactly what that is economically, and more importantly, what the Fed just said regarding the labor market, how the Phillips Curve impacts that, and what it's going to mean for stocks moving forward for the rest of the year. So let's take a look at this thing, right? Here's your Phillips curve. The numbers themselves aren't actually important. That's going to vary based on the economy. What's important here is the fundamental relationship between inflation rate and unemployment rate. Obviously, where we stand right now, the Fed is trying to bring inflation down. What this curve shows is the understanding and relationship that inflation over the short run cannot go from point B right there to point A right there, which is where the Fed wants it to go to, without unemployment also going from point B to point A. And so what we have here, this vertical line that I'm pointing at right now, this is your long run Phillips curve. All this is basically stating is that at a natural rate of unemployment, which is the current unemployment rate, all economic factors excluded, it's that natural rate of unemployment that you're never going to get rid of, that a healthy economy will function at. Given that over the long run, inflation is going to be a vertical curve here, right? Like today versus 50 years from now at the exact same unemployment rate, prices are still going to be higher than they are today. That's how economies grow. The short run Phillips curve is what we're concerned with right here, this actual curve. And so right now, the Fed is trying to bring inflation from right around 5%, 4.5%. They're trying to bring it from there to their 2% target goal. We've gotten just about halfway there from a peak CPI of over 9%. They look at core PCE, but we're about halfway where they want this to go. The rest of the journey left to go is going to be the toughest because right now we've had a vertical shift in inflation a little bit, right? They're halfway there. We've actually seen unemployment go from, say, point B to here. The unemployment rate since the start of the rate hikes by the Fed in March of 2022 has decreased. And so the one thing that Jerome Powell just spoke on that is super important regarding this Phillips curve is that this post-pandemic labor market we're seeing, they're starting to think that there might be structural shifts to the labor market versus cyclical, which would be normal. And you would expect to see rates at zero, GDP exploding, businesses expanding. But after 450 basis points of hikes over the course of last year, the Fed expected things to somewhat follow this Phillips curve, where as inflation starts to come down to reach their target goal, you were going to see layoffs. You were going to see people losing jobs, people retired, having to re-enter the workforce that are entering, now unemployed again because they're seeking work again. They expected unemployment to go up. However, it's actually gone down. And so that's really what remains a big topic here and a troublesome data, because if they can't get unemployment to tick up, as unfortunate as that sounds, inflation is going to be extremely sticky from this point on where we're at and moving forward. To get down from this level that we're currently at here at the start of 2023 to their ultimate target rate of 2% is going to be almost impossible unless they can get unemployment to rise. So as I'm sure everyone's heard the term entrenched, this is exactly what they're talking about. If we get to a situation where the strength of this labor market is actually a structural shift versus cyclical, and people who exited the workforce within this wealth bubble that was created over the last 5 years, if they still choose to remain out of the workforce, there's right now 1.9 jobs available per person seeking employment that is unemployed, right? And so what does that mean is even with the mass layoffs we've seen in tech and across the board in retail sales, people are losing jobs at one place and jumping right into another job somewhere else. And so until people start coming out of retirement and re-entering the workforce to try and bring this metric back, even at these slightly higher cost of borrowing and, eggs at whatever the hell they're at a dozen now, like $7 I saw in California, right? Regardless of all this, if people still have enough money to purchase everything that they want and enough money to not go looking for another job, right? That would be the biggest thing. If you still have enough money to comfortably not have to work, then demand is still going to remain elevated to the point that prices aren't going to come down the way they have to. And so Jerome Powell just said on Monday and last week at the FOMC meeting that they're starting to see disinflation in certain sectors, but the majority of the sectors, they're not yet. Does inflation from this point on remain extremely sticky and get to that entrenched point where basically it's stuck at elevated levels? And when asked about this, the Fed and Jerome Powell said they would never even consider raising their target rate. That would be ultimately the only other thing you do, right? If you can't ultimately get inflation down to where you're looking, and the labor market has a structural shift, we're starting to get entrenched in higher levels of inflation, do you ultimately just raise your target rate and say, okay, I guess 3% is the new normal? Is that fine? They've said they're not going to do that. They're sticking to their narrative. They're trying to get inflation back down to 2%. They will not waver in their determination to bring back price stability to 2%. And so that being said, ultimately what they're doing is when they say higher for longer, what they mean by that is whether we get continued rate hike, maybe we get, 50 more basis points on the upper end of the bound, and then they pause it there. What they mean by higher for longer is not necessarily insane amount of more hikes. It's that they're going to pause, but they're going to pause and hold it there for a while. A pivot, they've said multiple times, a pivot is out of the question before the end of the calendar year. And ultimately they want to see something break first, whether that's inflation or whether that's the economy. We'll have to wait and see. But until the labor market and this unemployment rate starts to uptick, the Fed basically has the green light, right, to hold rates higher. So they want to see us go from point B to point A, not from point B to where my finger's at, and basically create a new Phillips curve. That's not at all what they want. They want to see unemployment uptick to stay along the same curve and get inflation down. So we'll have to wait and see, right? This is a really interesting time. And we'll see if they stick to their higher for longer mantra. And if so, how long can they maintain that until something fundamentally cracks, whether that's inflation and we start to see deflation, and that becomes a whole nother problem in and of itself, or whether we see something fundamentally sound crack within the economy. We start seeing, out of nowhere, unemployment rate skyrockets to 8% and they send us into a recession. The Fed has yet to perform a successful soft landing. So that's kind of where I'm leaning. We'll have to see how this pans out. It's going to be a really, really interesting 2023, especially for macro guys like myself. The better part here though, right? What does this ultimately mean for stocks? Understanding all this economic relationships is great, but how do you apply it to stocks? How do we make money with this, right? Ultimately, what this means is what the Fed is trying to do by this relationship and getting unemployment to go up. When unemployment upticks, what is going to downtick? It's going to be retail sales. It's going to be consumer demand. It's going to be spending. That is what they really want to happen. Unfortunately, unemployment has to go up for that ultimately to happen. Is you need people to start making less money if, going unemployed, making no money. That way they start consuming less in the grand scheme of the entire economy. That's just what has to happen. So the Fed is trying to bring down consumption, because ultimately the supply side of the equilibrium between supply and demand for, your price point equilibrium, they can't really affect supply. That's out of their control. They can only affect demand. So they're trying to crunch the demand side of the economy. So what does this mean for companies? Ultimately, what this means is by holding higher for longer, companies are going to be making less revenues. And that's ultimately what leads to this unemployment uptick. It's a domino effect where if companies are forecasting themselves making less for the calendar year, the cost of borrowing, the cost of expansion, the cost of production is all up, right? Because you have to think the input goods they're getting are also elevated. Everything is more expensive. They're now forecasting they're going to be making less. Rates are higher. So any debt they take on is now at higher margins, higher interest rates. So it's less profitable for them to even take on new projects. What do? You have to get rid of some of your workforce at the end of the day. You have to lay employees off. That is what ultimately leads to this relationship. But in the short term, until that happens, that's what they're going to do to try and save EPS. But ultimately, profitability is going to be on the downturn. A lot of companies even just forecasted that. If you listen to any of the recent earning reports, Microsoft, Google, Amazon, all were notable names that said consumer spending is down, but so is business spending. And so a lot of these companies where Microsoft, Google, Amazon, they all rely on cloud services and their corporate logistical programs, right? With AWS, with Microsoft Azure, those companies at the forefront of consumer, retail, and business spending are really going to get hit. Amazon last year only made 62 cents per share on the entire calendar. It is currently trading at 170 trailing PE. And so a lot of these PEs are just super, super rich right now for really where these companies, I think, should be trading at, just given how they're going to perform the rest of the year in terms of revenues, in terms of EPSs. We're really getting to this point where last year it was inflationary scare. This year, I think it's just plain and simple overvaluation right now for what's exactly going to happen. All right, and that is going to do it here today. Thank you guys for watching. Hopefully you learned something. Tackled the Phillips Curve for episode 1. We got a lot more coming your way here. Macro Matters with Money Mander. So if you like the video, please subscribe, like, comment. Really helps the channel, and I want you guys to get notified when a new video is coming out here. And I'll see you guys next time. Mander out.